Hello, Matthew Bell with InsurancePrescription.com, and today I want to talk a little about the difference between a level premium and a non-level premium. Now, a level premium is going to be something that is going to be a fixture of several different policy types. It might be a fixture of a term policy, so some term policies have level premiums, some don't. It is mostly a fixture of whole life products, because in whole life the idea is the premium that you are paying has been established once the contract is put into force and really doesn't change. There are riders that might change that calculation. There are other factors that might be involved, but for the most part, a whole life policy is going to be characterized in part by a level premium. And all we mean by a level premium is one that is going to stay the same every policy year. So if you're paying monthly, if you're paying yearly, the amount that you're going to pay at the end of the year is going to be exactly the same amount one year after another after another. Once again, there are factors that can modulate this. If your whole life policy is dividend paying and you're using the dividends to offset the premium and the dividends are varying, then you're going to expect to have a different balance. But what we're talking about is the actual bill that's generated on the base coverage itself. I'm going to illustrate the difference between a level premium policy and one that is not level. And I'm going to use term as an example, but I could use a number of different policy types for this. All it is for illustration purposes, just to kind of establish the very basics of what we're talking about. That's important to recognize that when I'm talking about a level premium term product, I'm not necessarily saying that the term itself has a level death benefit. And it gets a little bit confusing here, but the premium is what you put in, and the death benefit is what is paid out in the event of the insured's death. So with term products, there can be a level term product payout, there can be a level payout, which is called a level term, and then there can be payouts that decrease over time or payouts that increase over time. So one reason that a person might want to have a product decrease over time might be that they're trying to cover, let's say, mortgage or some other kind of a debt, and they expect that the debt is going to decrease over time and that the insurance need they're going to have is going to likewise decrease. And then it can be planned for in the policy itself. A reason a person might have increasing term is perhaps you're getting it at a young age. You anticipate going through several different raises or job changes potentially in the next few years, and so you opt to get an increasing term policy in order to cover not just potential income replacement needs now, but also to keep pace with potential income replacing needs as your family changes, as you go through these increases in your pay scale. Level term, on the other hand, is going to be a product that's going to have a consistent payout for the entire duration of the term. Now, term and whole life, and I've gotten into many of these things in other videos, so if you want to explore at greater length the difference between term and whole life, I have an entire video on that. In fact, I have several videos on that. I have one specifically on term, one specifically on whole life, another video where I kind of put them next to each other and give you ideas as to why you might favor one over the other depending on the application. I've also talked about the difference between paying into a policy annually versus paying into the policy monthly, and how sometimes paying it annually can stand to give you a slight discount, and I have explained why that is in a separate video. Here, my ambition is to show you how a level premium policy works from the standpoint of some of the very basic policy mechanics. In order to show this, I'm going to compare a term that is level premium with a term that is not a level premium. And for that, I'm going to select an annual renewable term. So an annual renewable term is somewhat just like what it sounds like. Every single year, the policy sort of one-ups, and you have to opt into it every time. Now, just as a kind of a piece of background information that's going to be relevant, the premium that you pay is going to be a function of several factors. One factor is going to be your underwriting, your health, and so on. The other is going to be the size of the death benefit, the type of policy, and the riders that go along with it. But one factor that is going to predictably change year by year is going to be your age. So that is the factor that I'm going to track along with. So with annual renewable term, let's say whatever health rating you get at the time you put the policy into place, you have a specific premium. If it is annual renewable term, the next year the policy is going to be a little bit more expensive. And the next year after that, a little bit more expensive again. And it's going to keep pace with your age. It's going to get more expensive as you age, all other things being equal. Death benefit's the same, your underwriting hasn't changed, you're not being re-rated or having some kind of a surcharge fall off or be added on. You are simply experiencing an increase in your premium because of your age. Now, with a level premium. There is a way in which the insurance company essentially averages the amount of premium that you're going to be paid. Now I'm just going to show you that in a simple illustration. So firstly, let's consider annual renewable term. The curve that I've drawn essentially represents, as you age, the premium increase. Now I've compressed it. It's not altogether accurate. You'd have to map it out actuarially based on a particular person's aging and premium curve, but this is just for illustration purposes. So annual renewable term gets more expensive every single year. Now, alternatively, we could illustrate it with a kind of a step, a more linear way, and I'm going to put these side by side and kind of let you see them. Now, the actual increase that you're going to experience with annual renewable term is going to be much more like the curve on the left. But in a way, this illustration may be a little bit easier to understand. So I'm going to start with the curve and we'll move into this. So essentially the way it works with annual renewable term, every single year your premium that you pay is going to get more expensive until you opt to not keep the policy or it's no longer available to be renewed. So some policies can't be renewed just indefinitely. There's a particular period of time over which they can be renewed. Level term, on the other hand, is generally going to be put in place for a certain predetermined length of time. 10 years, 20 years, 30 years. And the way that that's going to work essentially is going to be something like this. With a level term product, you're going to have a beginning date and an ending date. And this is going to be contractually specified. And what's going to essentially happen in comparison to annual renewable term is that when you have the policy put in place in the beginning, you're actually paying more than you would have paid for a comparable annual renewable term product. But in the end, you're going to end up paying less than you would have paid for a comparable annual renewable term product. So early on, you're going to be paying more. Here's the amount you'd be paying in an annual renewable term, and here's the amount you're actually paying in your level term, and it's greater. In subsequent years, once you cross this sort of point here, which for every policy will be slightly different, you're going to end up paying less because here's what you're actually paying in the level premium and here's what your premiums would have been for annual renewable term. To try and illustrate that a little more, let's consider an example with some actual very simple, very abstract numbers. So I'm going to say, let's say the first year's premium is $1. Nice policy. Second is 2, 3, 4, 5, 6, 7. So 7 years, $1 more each year. Just for illustration purposes, your actual policies are not going to work this way. But let's then say every year, if you had this policy, at the end of the 7 years, you would have put in $28. 1 plus 2 is 3, plus 3 is 6, plus 4 is 10, plus 5 is 15, plus 6 is 21, plus 7 is 28. So you've put in a total of $28 on this example, but it's put in a different way. $1 the first year, $2 more, $3 more, and so on all the way through. On the other hand, if you opt for a level term product, then the premium is going to be set on some particular level. So let's say, in this particular case, it's $4. That's your level term premium. If you're paying it in an annual renewable way, it's going to go up and change every year. And if you're paying it level, it's going to stay the same. Now let's say this is a 7-year term. Very odd policy, I grant you. So in this case, what have you put in over the course of 7 years? Well, 4 times 7 is also 28. And so you've put in the same amount of money. And why does that work? Well, it works because of this. The first year, you've actually put in the level product, you've actually put in $3 more than were required in order to have the policy that year. In the second year, you've put in $2 more. In the third year, you've put in $1 more. In the fourth year, on this example, the premium you're paying in the level term matches exactly the premium you would have paid in the annual renewable term, so the difference there is 0. And in this year, you're still putting in $4, so you're actually putting in 1 less. And in this year, you're actually putting in 2 less. And in this year, you're actually putting in $3 less. Well, what you can clearly see from this example is that if you've added in 3 plus 2 plus 1, over the first 3 years, you've added $6 in extra over what was required to cover the actual cost of insurance. Well, those same $6 are applied on the back end, because in the back end, you actually are running at a shortfall or a deficit of $6 because your premium now is less than the actual cost of insurance. But everything works out, and in my example, it's very easy to see that you've paid in exactly the same amount over the course of that term that you would have paid in the annual renewable product. Now, in general, that is the way that level term works. For some people, choosing a level term product makes more sense because they want to have that average cost. They want to not have that rate increase experienced every single year. There can be competing factors, however. So suppose you only needed the policy to cover you for the first 3 years. Well, if you needed the policy only for the first 3 years, then the annual renewable term would be the superior option, because in the first 3 years of that policy, you pay in only $6 versus the first 3 years on my example where you would pay in $12. And so the annual renewable term might be very good if the interval that you need your insurance coverage over is shorter than what was available with a level term product. On the other hand, there can be differences in terms of the face amount. So with some insurance carriers, certain product types are only available with certain levels of coverage. So for instance, you might be able to pick up an annual renewable term for $15,000 of face amount, whereas there is no comparable level term product with that particular insurance carrier. And just a word on this example here. So when the policies are renewed, once again, you would just simply have, let's say you have a renewable period. Well, the same idea applies. It's just that the math is going to be at a different place on the curve. So I hope that shed at least a little bit of light on what a level premium product is. And if it did, if it helped you or answered a question that you may have had, I ask that you click the like button, click subscribe, click the notification bell to be alerted to new content as it becomes available. I thank you so much for joining me today, and I look forward to seeing you again in another video. Thank you so much.